This week's video is all about company directors and getting a mortgage, so find out more. Hello, welcome back to our channel and podcast. My name's Gemma, and here at WIS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Iftika joining us. And for those of you who don't know Ifti is a trained accountant and mortgage advisor who has been in the industry for over 11 years. Welcome back, Ifti. How are you today?
I'm very well, thank you. How are you doing, Gemma?
Yeah, I'm doing well, thank you. So today we are getting into the nitty-gritty of mortgages for company directors. So I guess maybe one of the first places we should start is about being how much of a shareholder you have to be a company director and how that might affect your mortgage.
Yeah, so company director is somebody who runs a company. Usually it's a limited liability company. So as a shareholder, usually, let's say there's 100% shares in the company and people can own, if it's a small company or we call it closed company. With a closed company, you generally have maybe one or two shareholders, maybe three shareholders at most, right? So the ideal scenario is the mortgage applicants, right? Let's say individual or a joint applicant, they own 100% share of the company, right? Because that's the ideal scenario that you want to be in, because that gives you more options then, right? But if you're sharing with someone else, that means, you can only account for part of the income, right? So if you're sharing with your, say, spouse or, your partner where you're living together, that kind of scenario, 100% is fine if you're doing the mortgage with them. But otherwise, it can have limitations as to the options that you can come up with, yeah.
And why does it have limitations, Ifti?
So let's say you have a 50-50 shareholder. So me with one of my mates, I run a company, right? So he is responsible for 50% of the income and the expenses, and I'm responsible for 50% of the income and expenses. So if that's the case, what banks worry is if tomorrow he is not in the company, we might not bring the same amount of turnover. So let's say I bring a set of clients to the company and my mate brings a set of clients as well to the company. So tomorrow, if my business partner is no longer in the business, he might not bring clients to the company. So if it's not going to bring clients to the company, your turnover can be impacted and your profit can be impacted. So therefore, banks worry about it, right? So in scenarios like that, they will look at the 50% income and they'll look at 50% share. Most banks will, but some banks will not like to give you a full mortgage based on the full turnover.
Okay. Great. Thanks, Ifti. The next question that I'm going to be asking is more about SA302's and company accounts, because lenders can look at sort of both for income and then affordability. So I was just wondering if you could give us more details on how each of those might be different and why.
So these are two different things. SA302 is a personal thing. The company's accounts is to do with the company, right? So as an individual, if you are a company director, you have to file something called a tax return, right? That's called a SA302, right? So that's a long document where you fill out. Usually it's done online nowadays because a lot of people don't do paper-based forms, right? I'm not sure the HMRC accepts those anymore, but a few years back they used to. So you file your tax return online, and that's called a SA302. Now once that's done, there is something called a SA302 that comes out. The SA302 is actually the summary of the tax return that shows your, say, in a company director's case, salary plus dividend, right? Now that is personal, right? So because it's filed for me. So if I have the same scenario, if I have another business partner, he will file his own SA302's, right? Or SA300's. I will file my own. I might have other income like interest income. I might have things like, investment income. I might have things like, rental property income. I will include all that in my SA302's, right? But if you look at the company accounts just looks at the snapshot of the business, how well business has done, and they sort of summarize that. That's from a business point of view. It does not include other income. It solely shows how well your business has done. So that's how it is. Now, if you ask me which is more advantageous, unfortunately, most banks prefer SA302's because they know that is actually purely your income, right? So that's what it is. But there are some banks who will look at company accounts. I think this goes back to your main first question. So if you're a 100% shareholder, they will consider your company income in full. But if you are 50%, they may consider 50%, right? Because what happens is, a lot of people, whatever money they make, they do not draw out all the money from the company, because the company, they want to retain some money so that they can invest in future and make more money. That's the whole idea, right? So there is always retained profits. So they will. So sometimes it's advantageous to look at company accounts rather than the SA302's, right? Sometimes you will look at a combination. Sometimes banks will want to look at both. But we know there are some specialist lenders who will look at company accounts, right? And also for tax planning. Obviously, again, I'm coming from an accounting background. For tax planning purposes, sometimes people only take minimum salary and dividend, right? So for people like that, when they try to take a mortgage, sometimes the affordability doesn't work if you go with the SA302 route, because you're only looking at salary and dividend. But the company has more profit, right? So that may work better.
Yeah, but I wonder, how does it change for people that have had a recent loss? So say they've got, one good year, one bad year or something. Does that make a difference?
It does, right? Unfortunately, banks don't like losses. If you have losses, if you're looking at the company accounts, you might struggle to get a mortgage, right? I'm not saying it's impossible, but your chances are next to nothing trying to get a mortgage off the bank, right? Speak to an advisor if you have an issue like this, because sometimes if you can explain why there's a loss, maybe the advisor can speak to a few specialist lenders and come up with a solution, right? But if you have a loss, it's always difficult to work out a mortgage. It won't be very straightforward, because the standard, high street lenders may not be an option for you.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
And what about for those people that haven't necessarily made a loss, but they just haven't made as much profit, net profit, as the previous years? How's that sort of taken into consideration?
So banks do something called averaging, right? So they usually average your income. They look at last year, what you made, this year, what you made. Let's say you made 50 last year and this year you made 100, right? So they average it and they take 75. That's the sort of mean between the two, right? So they will take 75. But what happens is, if your income drops, banks generally have a problem, right? Because they think it might be a downward trend, right? So they generally go with the lower of the two. That's what the banks do if you're going with the company accounts, right? But sometimes if it's SA302's, you might be okay because they're looking at your tax return, right? But yeah, drop in income, banks always worry. They might need additional proof that this year is actually not dropping, because they might want to see that trend. So they might get letters from accountants. They might look at their last few months' bank statement to see whether there's an upward trend in the turnover.
Yeah, so for those people company directors that might have invested some of their profits that year into, back into the company, maybe they got a new website or something like that, then maybe the accountant can sort of show that's what it was, and that will suffice the lender, or would that not?
So again, it might be case by case, because lenders generally, nowadays a lot of things are computerized, right? So once the numbers go into the system, the computer makes the decision on behalf of the lender. So there are some lenders who do common sense lending. So it is worth having a conversation if there was a exceptional expense that's gone through the business, right? Like you said, it might be a massive website they develop for the company. Instead of capitalizing it, they decide to consider it as a revenue expense, right? So if you do that, you might have a massive impact on your bottom line, right? So if there is an impact on your bottom line, it's always worth having the conversation, because there might be a lender who might say, what, it's one-off, right? This is the other thing that we see often, pension, right? Because it's tax efficient, a lot of people just pay a pension out of their business account, especially towards the end of the year, right? And because there's a 40,000 allowance, sometimes people try to make use of it. So that sometimes dents your accounts, right? Because it creates a massive dent, because obviously 40,000 is a big number. For me, the way I would look at it is, that's my income, because that's 40,000 more, right? But the bank might not see it that way. So that's when things like common sense lending comes into play, right? Because it's probably a good idea to talk to the bank and say, look, not all banks will accept it, but lenders who do common sense lending might look at it, right? So you might be able to go and say, this is because of pension, right? So that's kind of what it is,
Yeah, thanks, Sifty. That's a great point. Now, if you guys have watched any of our previous videos, you'll see that we have done one previously about the documents that you will need for your mortgage. But specifically, when you're a company director, Ifti, is there anything additional that you'd have to provide in terms of documentation to a lender?
Generally, lenders like to see the SA302's, right? They would like to look at the company accounts. That's something that they would like to do. They will also like to look at your bank statements, the business bank statements, as well as the personal bank statements, to see how well the business is doing and how you're managing your finances by looking at your personal bank statements. So apart from that, they might need the ID sort of verified and, maybe your address verified, right? So that's mainly what they're after. But, there are instances where they want certain clarifications that we wouldn't know in advance. So underwriters might say, okay, can we have a note from your accountant to say, this is why your profit is low this year, right? So you might sort of need that odd one. But generally, this is what we are looking at.
Yeah, great. And maybe we should just kind of touch on the loan to value ratio. So, as a company director, can you still get those, 95% mortgages, 90% mortgages like a regular...
in theory, it shouldn't affect you, right? Because you should be able to get 95 because it's open for everybody. But I think with the last few years where COVID has sort of struck a lot of businesses, and especially people who are self-employed, was impacted a lot. Some of the banks have taken a bit of a cautious step, saying that, okay, 95% products are available, but it is only for employees, right? So we have seen that. I'm not saying you can't do it, right? But the options may be limited. You might not have all lenders who offer 95% mortgages who are willing to offer a mortgage to you.
Yeah, thanks, Ifti. Now, COVID, although it's kind of past us now, it seems, but there have obviously been years which have been affected by COVID. So how do lenders take that these days? How do they view bad year due to COVID?
Well, unfortunately, like what you see in the news, COVID is still lingering there, right? So it's not one of those.
Not gone yet.
It's not gone yet, right? So it can
Wishful
cause.
thinking.
I know it can cause problems, right? Because as you mentioned, COVID has had impact on some of the businesses. So your last year's numbers may not look as good as this year, because last year is when most people were impacted by COVID, right? So if you're using the formula I mentioned before, averaging. So you will have a low year and you might have a high year. So banks generally try to average the two. It may not seem fair, but again, this is when things like common sense lending or bespoke underwriting becomes important, where we could go and talk to a lender and tell the lender, look, he was impacted because of COVID, but that was just one-off because the whole industry was impacted. Can we just look at the latest accounts, right? So there will be some lenders who will accommodate that, right? Not everybody will, but there are some who will, right? So those are options that we can consider.
Thanks, Ifti. The last question I have for you is something that I feel like I get kind of quite a lot from people. They say to me, oh, can I not just pay myself some extra dividends for the last couple of months and then it will boost my income up?
Yeah.
What would you say to that type of customer?
Good question, and a common question, like you said, right? So unfortunately, if you go back to one of the first questions that you asked, right? Banks mainly look at your SA302's or your company's accounts, right? If you're a contractor, they look at your contract accounts, because contractors, most of them fall under this limited liability area as well, right? So those are the three main areas they look at, right? So just because you take a big dividend now, if it is not reflected in your SA302's, that might not make any difference. But let's say you're taking the company route, you're showing the company's accounts. If you took a dividend last month and this month, but your company's accounts close, say, 4 months ago, that's not going to be reflected in your accounts either, right? So that won't really count for anything, right? So it really depends, right? But let's say, your company year end is, say, this month, right? It's finishing end of this month, and then you're taking dividend, then it's fine, right? Because you can show it in your accounts, right? And let's say you're sort of end of March or something like that, you might be able to show it in your current SA302's. So in instances like that, perfect, right? But otherwise, it might not. Again, before doing this, seek advice, because dividends, if you take, there is tax, right? So there might be tax implication. So you might not achieve the house and you might lose out on the tax as well, right? So you probably want to check this before you do it.
Yeah, tax for dividends have just gone up, hasn't it?
Yeah, that's right. Yeah, it's gone up by 1%. Yeah, that's right. Yeah.
Okay, great. Thanks, Ifti. So is there anything else you want to add?
Yeah, self-employment is always tricky. Unlike employed, where banks can easily verify your income with HMRC and, pay slips, all that sort of thing. it's easier to get that kind of mortgage, right? But with self-employed, it can be a little tricky. Like you said, there can be odd scenarios, right, where person's income has dropped last year, or person has spent on some exceptional costs. So those are scenarios which can be a little tricky. So if you are using the bog standard self-employment route for them, it might not really work. You might not get the numbers you want, right? So it's always best to get some advice if you are like that, right? I'm sure people can guide you. Like I said, there are different routes you can take as well. Sometimes if SA302's don't work, you can look at company accounts. If you're a contractor, you can look at the contracts. There are things that you might be able to do, but not all banks will accommodate this, right? So if you go to an independent advisor, they might be able to put you on the right track, right? So yeah.
Thanks again, FD, for some more great advice. I'll just put our regular reminder out there that these points may or may not be applicable to everybody, so please do check to see if they are suitable for you. And if you don't have an advisor, I will leave our WS contact details below, as we are always more than happy to help. A little reminder that as a mortgage is secured against your home or property, it may be repossessed if you do not keep up with the mortgage repayments. Thank you for joining us again today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.